Welcome back to Watch Your Assets, where we've got your money on our minds. I'm your host, Stephanie Bracken, and we are going to do something a little different on today's episode. So we're going to talk about some frequently asked questions that you, our clients, want to know about. So I have a list of questions that I'm going to run through, and I hope that I can answer some of them. So let's get right into it.
Will Social Security be around when I retire?
It's a great question. And it's a valid question because there's a lot of talk in the news with the Big Beautiful Bill and other pieces of legislation that are just being thrown out there. How do you know what's going to happen, right? So, of course, we don't have a crystal ball, but I'm very optimistic that Social Security is going to be around in some capacity. It's just that over time, if the reserve depletes, that's kind of the big issue that is coming, is the fact that the reserve is going to run out of money. The reserve the pool of money where they pay out your benefits to you, that is set to run out of money in a couple of years. And when that happens, the big question is, what will happen? And so we're optimistic that something major will happen in terms of legislation that alters the benefits in some way, but doesn't completely eliminate them. We're of the mindset that if Social Security benefits were to completely disappear, that would cause a huge uprise, regardless of who is in office at that time. Blue, red, doesn't matter. It would be a huge, I think, political suicide almost for that person to completely wipe out benefits. So I think we're going to see changes like raises in payroll taxes, or a decrease or an adjustment in the cost of living adjustments that happen on benefits, or perhaps an increase in when you can take your benefits. So currently, obviously, you can take benefits starting at age 62 to age 70, somewhere in that time frame. But maybe they raise that and say you can't start benefits until you're 65, and now your new full retirement age is more like 67, or I'm sorry, it's 67 now. It's 68 or 69 perhaps in the future. But it's not, we hope it's not going to go away completely. We think that would be a huge detriment to most Americans' retirement plans. And so it's up in the air of the legislation behind it, but we're optimistic that Social Security, at least for the 50, 60, 70-year-olds, is going to remain about the same as it is now. For the 20, 30-year-olds, might see something different. But for current time, for the next probably 20 years, we hope that it's going to remain pretty much the same as it is now.
When should I take my Social Security benefits?
Yeah, great follow-up question to the first one, of course. So as I said, you can take Social Security anytime between age 62 and age 70. And it kind of depends on your situation. I'm going to say this a lot, probably in this episode, as I do in most episodes, because this isn't a one-size-fits-all. Most of these of financial planning is not one-size-fits-all. So if you retire at 55, you can't start your benefit until at least 62. So there's no way around that piece of your retirement. So you have to figure out, do you have enough assets enough savings to last you from the time that you retire around age 55, if that's your plan, to age 62, which is the earliest that you could elect your benefits. That's an extra almost 10 years worth of savings that you are going to have to plan for, and it's going to extend the length of time that you have to stretch out your savings. So that's a consideration, is when you retire. If you retire at 63 or 64, you wouldn't want to start your benefit at 62 because Social Security will penalize you for taking your benefit early and still continue to work. The reduction is a $1 reduction in your benefit. For every $2 over, there's an income limit that Social Security looks for as you earn money. I believe it's around $22,000, $23,000 for this year. So as you make money above that threshold, they're going to start to reduce your benefit. So they're penalizing you for taking that benefit early and still continuing to work. Now, that penalty goes away once you reach full retirement age, which is, again, 67. Could be 66 and some odd months, depending on when you were born. For most people, though, it is 67. So if you are working and you want to keep working until age 70, you can elect your benefit after age 67, get whatever is due to you without any kind of penalty and continue to work and make as much as you want to after that point. Now, if you want to keep working past age 70, you want to take your benefit at least at age 70. Again, there won't be any penalty for that, but you delaying your benefit past age 70 has no advantages. They'll only back pay you for so long after you turn 70. So you're losing money by not electing your benefit. So taking it at 70, if you want to retire at 70, is the way to go, because you're going to get your max benefit. You can still work. There's no income limits, and you're going to, of course, take advantage of the money that's owed to you because you paid into the system for all of those years. Now, if you retire within that 62 to 60 or to age 70 range, if you don't necessarily need the money, you can theoretically delay your benefit. When you delay your benefit, you get a little bit of a bump in your benefit whenever you do eventually take it. So, for example, if you retire at age 62, but you decide that you don't really need that money and you can live either on your pension, your retirement savings, or somewhere else, then if you say, I want to delay my benefit until age 67, there will be an increase in your benefit whenever you take your benefit at 67 versus if you would have taken it at 62. So there's a permanent increase in that benefit depending on when you start. And there's a lot of other considerations here. Now, there's a break-even point. So if you take your benefit at 62, don't necessarily feel like you're missing out on money because you didn't wait to take your benefit. That benefit that if you would have delayed your benefit, it'll eventually catch up. So if you live past age 70 or 78 or 79 or so, right in that range, you'll about make up for that lack or where your benefit could have been if you waited until age 67 to elect that benefit. So it just depends on your income needs in retirement. It depends on when you retire, and it depends on your family history and your life expectancy. Now, that one's a little harder to predict, but if we know when you want to retire and we know your living expenses, we can usually tell you what's an appropriate age to take those benefits. Sometimes it also is beneficial to take your benefit early if you have high living expenses. So if you know that you're going to need to take money out of your portfolio, sometimes taking your benefit earlier can help to mitigate your withdrawals, to stretch your savings over a longer period of time, versus if you delay your benefit and you have to pull out more in those early years of retirement, you're going to possibly be subject to what's called sequence of returns risk, where you're in jeopardy of taking money out of your portfolio in potential markets that are volatile, where the market might be down 10% and you want to pull out 5%. So now you've lost 15%, and because you're not putting money into your accounts anymore, it's a little harder for those accounts to recover. So sometimes Social Security can help to bridge that gap, where you can take a little bit less out of the portfolio, stretch that savings over a longer period of time, and get some guaranteed income, of course, from SSA.
When can I retire?
This is going to be another one of those ones that is I don't know. It's a kind of a hypothetical. The general answer is whenever you're financially ready. But how do you know when you're financially ready? Well, that's where you need to sit down and come up with a good financial plan. Whether you do that yourself, whether you come to us and you ask for our help, we can put together a good game plan where we will analyze your income, your goals of when you want to retire, your living expenses, which is a huge part of it, because again, that's going to determine how much we think you're going to need out of your portfolio in retirement, your pension and other retirement income sources that you might have, Social Security, of course, being one of them. And we're going to put all of those pieces together, and we're going to tell you whether or not you can retire. So the short answer is whenever you're financially ready, but it's going to depend on a lot of different factors, and it's going to be very specific and unique to you.
Should I pay off my mortgage with the distribution from my retirement accounts?
This is a very popular question. So I know that it's frustrating to have a mortgage payment. This also is going to depend on your situation too. But a lot of the times people want to go into retirement debt-free. And they see this big pot of money that they have in their retirement accounts, and they see their mortgage balance, and they see how much longer it's going to take them to pay off that mortgage. And that's a bit daunting. And it can be very tempting to want to take a big chunk of your retirement and pay off your mortgage. Typically, we don't advise you do that But it depends on the interest rate, and it's going to depend on your situation. But if you've got an interest rate that's 3, 4, 5%, typically we recommend that you continue to pay your normal mortgage payments and then let the loan amortize, and you will just pay it off on its normal schedule. If you make one extra payment per year on your mortgage, you will cut the life of your mortgage in half. You also can do the same thing if you pay bi-weekly on your mortgage instead of paying once a month. That helps to it helps to eat into the interest a little bit more. So if you make one extra payment a year or pay bi-weekly on your mortgage, you'll cut the life of that mortgage in half automatically. So that might be a strategy that we recommend versus taking money out of your retirement accounts. And the interest rate thing, back to that, we think that even in retirement, even if your portfolio is a little more conservative than it was while you were working, we still are optimistic that if you're invested in S&P-like funds where you're getting market level returns and you're keeping up with market growth, that your growth on the accounts is going to outweigh the interest rate on your mortgage. Now, if you've got 8, 9, 10% mortgage rates, that might be a different conversation where maybe we need to pay a lump sum that's not completely paying off the mortgage, but maybe it's something towards it. But it's a conversation of, again, it comes down to you, because we don't want you to eat into your retirement savings either. So I know it's a big bill, but hopefully you have enough with Social Security and with your portfolio assets to just keep paying that mortgage off over time. But taking a big lump sum is back to that sequence of returns risk where you're taking out $200,000 from your account to pay off your mortgage. Yes, you don't have a mortgage payment anymore, but now you're missing out on the growth on those $200,000 worth of assets that it could potentially double for you over 10 or so years, even into retirement. So that's the trade-off there.
Should I sell my house to my kids for $1?
This is another very popular strategy that people want to take advantage of. A lot of the times people want to downsize in retirement, but they might not want to potentially pay capital gains on that money. They might not want to pass away with that asset because it's going to be part of your estate. It's going to be part of the probate process. So a lot of the times what people want to do is they want to sort of get rid of their house and give it to their kids. So that's one of the advantages. So one of the advantages of doing that is that it gets that asset out of your estate, so it helps you avoid probate on that particular asset. And then it also lets you retain control of that asset, so you get to dictate when that asset is quote unquote sold. Now, there's a lot of disadvantages to doing this though. So this is just things to consider if you want to do this. Number one is there's a gift tax implication to doing this. So this, because you sold it for $1, the IRS deems that to be a gift rather than a sale. So that gift is going to be equal to whatever the fair market value is of the property when you sell it to your child, minus $1, which was the purchase price, right? So if it's a $400,000 house, you will have gifted, in the eyes of the IRS, $399,999 worth of assets in that year. Now, the annual exclusion limit on gifts, according to the IRS, is you can gift up to $19,000 per person in 2025. If you go above that limit, nothing necessarily happens in terms of owing gift taxes, but you have to let the IRS know that you did that. And so you'll have to file a gift tax return with your taxes at the end of that year. And it's also going to eat into your lifetime exclusion amount. So the federal exemption is, I think, 13.99 million of federal estate or what your estate can kind of use to avoid estate taxes. So if your estate is worth less than 13.99 million, you won't owe any gift or estate taxes on that particular gift, but the gift is going to eat into your lifetime exemption. So that's one consideration. Another consideration here is your eligibility for Medicaid. So if you have an estate that is worth let's just say it's worth $500,000, and you gifted your house, which is worth $200,000. With Medicaid, the way that it works is they will look back 5 years across all of the gifts that you have given people outside of that $19,000 exclusion. So they're going to look back 5 years to determine your eligibility for benefits through the state, through Medicaid. So if you gifted the house to your child and then the next year needed to go into a long-term care facility and needed Medicaid to assist with those payments, they're going to look back on the fact that you only gave that gift a year ago, and they're going to exclude basically $200,000 of that sale because it's deemed a gift, and they're going to hold out on you up to $200,000 worth of benefits because you gave that gift before the 5 years was up. After the 5 years is up, no big deal. You'll be able to get your benefits. There's probably an elimination period where you have to wait maybe 30 days before those benefits will kick in, but they're trying to eat into your assets and your gifts before they will start paying out benefits because it's a state-funded benefit. They're trying to avoid paying benefits where possible. So that's where the 5-year look back comes into play, because you're going to have to tell the IRS and tell the state that you gave this gift, because they are going to look back, because they don't want you to, the thing with that, the 5-year look back period, is they don't want you to gift all of your assets to someone and then the next day need long-term care. So they're trying to help get around that again, because they're trying to protect their own pockets. So they don't want you to do that. That would be kind of taking advantage of the system. The other consideration here is the fact that whenever you pass away, the assets, that particular asset is your house is going to get a stepped up cost basis. So whatever that asset is worth on the day that you pass away, that is what whoever inherits that asset, that is what that person's new cost basis is going to be. So instead of assuming your cost basis, which is what will happen if you gift the asset to them. So if you paid $50,000 for your house and it's now worth $200,000, when you gift that asset, that person's cost basis is going to be $50,000. Versus if you pass away with that asset still in your estate, when that asset gets passed on to the next person, their cost basis is going to step up to the fair market value of that $200,000. And if they turn around and immediately sell that asset, they're not going to have to realize any gains. If they sell the house for $200,000 and their cost basis is $200,000, they won't pay anything in capital gains. So that's one of the advantages of doing that, is that whoever you're passing it on to is going to get a stepped up cost basis. So that can be some tax savings for that person later down the line. One other thing to consider there is that if you give your child your home, or another family member, it doesn't have to be a child, but a lot of the times people want to give it to their kids, giving it to a family member makes you lose control of that asset. So if they wanted to turn around and sell the asset, if they get divorced and something happens in the divorce decree where they have to split up or sell that asset, if they decide you're not allowed to live there anymore, they have the ability to do that because it's now their house. So you're losing control of that asset by doing that. So you don't have as much control over when you get to sell the house if you want to do that, because you gave it to them and now it's their property to control. So all in all, it's probably better to keep the house for yourself, unless you want to downsize and just sell it, but you want to sell it to another buyer. If you keep your home within your estate, yes, it's going to have to go through probate, but it's going to be better for whoever is inheriting that asset because they get that stepped up cost basis. Now, there are certain states that allow for a transfer on death deed where you can deem a beneficiary or name a beneficiary as part of that asset, but there are only certain states that allow that. Pennsylvania is not one of them, so that is an asset in Pennsylvania where your home is going to have to go through probate. You can put it in a trust as well, and that's a whole other conversation. Listen back to my episode with Dan Carr about estate planning for more information about that, but in general, it's probably better to keep your home within your estate.
Do I need to have trust set up for my legacy?
So trust, again, back to my episode with Dan Carr, trusts are going to be really specific to your situation. I don't want to say yes or no because it's very much going to depend on your needs. Not everybody needs a trust. If you have a will in place and all you have is retirement accounts that have beneficiary designations on them, you probably don't need a trust. Your beneficiary designations will supersede a will. That asset won't have to go through the probate process, won't have to go through the courts. It'll just automatically be inherited by the beneficiary. But it really just depends on your situation. So I don't want to say yes or no to that question. A lot of people, like I said in the last question, some people like to put their homes in a trust, in an irrevocable living trust, to help facilitate that process and help that asset avoid probate. But that's the biggest thing with trusts is to avoid probate. So that can be something to consider, but it's really going to depend on your situation. And I'm not an attorney, so I don't want to make any recommendations there. So it's definitely good to talk to an attorney about your options for your specific situation.
Should I keep my money in the market or shift to safer investments once I retire?
So I think a common misconception with this is that people think once they retire, they're going to not want to invest in equities or not be aggressive with their investments at all and want to move to safer investments, which is completely valid. And we certainly want to respect what you want to do with your money because at the end of the day, it is your money. However, if you want to retire, here I am again, retiring at age 55. If you live to age 90, that's almost 40 years that you're going to have to stretch your retirement savings over. So if you're in safe investments that aren't keeping up with inflation or aren't keeping up with market level returns, you're going to lose purchasing power to inflation. The value of the dollar is not going to be the same as it is today 10 years from now. So you're going to lose money to inflation. You're going to lose purchasing power, and you're not going to you're not going to have enough saved up to last you over the course of your retirement. So we want to make sure that you can stretch your savings over the long term for your retirement. We want to do so in a way that maybe is less volatile than just naked stock positions, and we have different investment vehicles that can help to kind of mitigate some of the risk of loss in your investments. But we still want you to keep up with market level returns. It might just not be to the level that you were whenever you were invested in your 401k and you were in 100% stocks. We might want to be a little more tactical with the types of investments that you're invested in. But I don't want you to pull all of your money out of your retirement accounts, let it sit in cash, and then you lose money to inflation and potentially outlive your money. So you definitely want to keep your money invested in the markets and pull out money when you need to, but we still want you to maintain a level of compounding growth over time.
How do I withdraw from my accounts when I retire?
Well, so basically what happens is whoever is managing your retirement accounts, whether you keep that at your current company in your 401k, whether you roll that over into an IRA, a Roth IRA, whatever that account is, basically your advisor or your fund manager becomes your payroll. So instead of getting a paycheck from your job, you're now going to be getting a paycheck from us. So you can specify how often you'd like money. You can specify how much you want. We can withhold taxes for you. We will link right to your bank account so that you let's just say on the 5th of the month, you want your money to come in. On the 5th of the month, you will just see a direct deposit from your accounts right into your bank account. So we can do all of that. We want to take the legwork off of you in retirement so that you don't have to manage your money, you don't have to manage your investments anymore, unless you like doing that. We also will manage your withdrawals for you. And then we can also say, hey, you've been doing this level of withdrawals for about a year. Is this still right? Do you still need this much? Do we need to scale back? Are your withdrawal percentages too high? Do we need to make adjustments to your financial plan? Do you have big trips that you want us to plan for where you might have to take out a larger chunk of money? So it's really customizable to you and to your needs, but it's just a shift from your job being your payroll to us becoming your payroll.
What does my will do?
So your will is what helps. It's part of your estate plan, right? So this is the document that helps to specify where you want your assets to go after you pass away. This is the document that's going to be submitted to the courts for probate. So your entire estate is going to be part of the equation, and your will is a great starting point for the kind of document that needs to be submitted to the court. If you die without a will, you are leaving the divvying up of your benefits and your assets up to the courts and to the state. So you want to avoid that where possible. So your will helps you dictate, I want this asset to go to this person, I want this asset to go into this trust, I want this to do this, my pets to be taken care of, my grandchildren to get this. You can specify all of that. It's very customizable to you. Now, as I mentioned before, there are a lot of assets that have beneficiary designations on them that bypass the will, they bypass probate. Where possible, we would love to see you have beneficiaries on most of your accounts. You can do payable on death for your bank accounts, transfer on death for non-retirement accounts. Retirement accounts automatically have beneficiary designations on them. That's Roth and traditional money. So there's a lot of ways to avoid probate. Now, again, some assets, it's unavoidable to go through probate, again, with your house, unless you have a trust set up where the house is either owned by the trust or the beneficiary of that particular asset is the trust. That'll avoid probate as well. It's not the greatest process in the world. It can be lengthy. It can be costly. So your will is a great starting point, but there are other measures you can take to help to facilitate the executing of your estate plan once you pass away. But in general, your will is the thing that helps to facilitate the probate process and really dictates where you want your money to go when you pass away.
Should I consider a Roth IRA or a Roth conversion?
Roth is a huge buzzword, big hot topic in the news right now. If you're into like Yahoo Finance or any kind of finance podcasts or, anything on the news, everybody's Roth. And Roths are really, really powerful investment vehicles because you put the money into it after taxes and then it's tax-free whenever you want to withdraw in retirement. But sometimes you have to consider the implications of Roth whenever you retire. So if you have a Roth IRA whenever you're 20, that's incredible. You're going to have years and years and years of compound growth before you ever need to touch that money. You can just let it grow tax-free with the markets, not necessarily caring about volatility. You can be super aggressive with it, and it's going to continue to grow with the markets over time. But if you are 60 and all of your 401k was invested in the pre-tax or the traditional 401k bucket where you were able to take advantage of some tax savings today whenever you put your money into your 401k, you got some, your contributions in that sense go into that bucket before you pay taxes on the rest of your paycheck. So you get some tax savings today. Whenever you pull the money out of your traditional IRA or your 401k in retirement, that money is all taxable, subject to ordinary income taxes. No capital gains, but it's subject to ordinary income taxes, which could potentially be less favorable than capital gains. But it depends on your income in retirement. If you're in a really high tax bracket in retirement, Roth conversions might make sense because eventually you will have to start taking out what are called required minimum distributions. I think I've mentioned those in previous episodes. But basically, even if you don't need the money from your traditional IRA or your traditional 401k, the government is going to force you to take distributions from those accounts because you never paid taxes on that money whenever it went into the account. So they want their share. And when you turn, it's 73, it's going to bump up to 75 in a few years. When you turn 75, you're going to have to take out a percentage of your portfolio because the government wants their taxes. So when you take that distribution, that's going to be fully subject to ordinary income taxes. And if you've got millions of dollars in a traditional IRA, that could be hundreds of thousands of dollars worth of RMDs that need to be taken out of the accounts every year, and possibly thousands of dollars of extra tax liability that you potentially could avoid by doing Roth conversions. But this is a really, really specialized piece of financial planning that is going to be very dependent on your situation. If you're in a low tax bracket and you need your retirement dollars to live on, Roth conversions might not make sense because you're going to have to pay extra taxes up front when you do those conversions. Sometimes it doesn't make sense. If you just need to live on that money and you're only in the 12% tax bracket, your RMDs aren't going to be that significant probably in terms of your taxes that you'll have to pay. Plus, if you need that money before RMDs start, then you're potentially double dipping into taxes where you're going to pay taxes on the distributions that you need for normal living expenses from your IRA, and you're also going to pay income taxes on the converted piece of that IRA, because when you convert, that money is going to be fully taxable again at ordinary income tax rates. But the goal with Roth conversions is to get the money into a more favorable bucket sooner before you let the growth continue to compound in that pre-tax bucket. Roth IRAs are not subject to required minimum distributions, so you only take out what you need from those accounts each year. And they're good for your beneficiary as well. So when a beneficiary that's not a spouse inherits a Roth IRA, they're going to have to take out the money within 10 years of inheriting the accounts. That was part of the Secure Act. But none of that money is taxable because it's all Roth, versus if they inherit traditional IRAs or 401ks, that money also has to be taken out within 10 years, but it's all fully taxable. So it can be a really powerful estate planning tool as well, but it's really, really dependent on your situation. And again, we could help you navigate what's better for your situation. Is it better to keep contributing to my pre-tax bucket of my 401k, or should I switch to Roth? We can help you discuss that conversation. Do I want to do Roth conversions in retirement? We can also help you determine if that's advantageous for you or if it's not. So it really just depends on your situation. That was all right? All the questions? Okay, great. Well, I hope you found today's episode insightful. If you enjoyed this episode, be sure to give us a like, follow us on all social media platforms. It is Watch Your Assets, and we will see you on the next one.